In this video, we will discuss the main provisions of IAS 21, effects of changes in foreign exchange rates. We will cover the objectives of the standard and provide you with a general summary of the provisions. This is Accounting 0 to Hero. We are here to help you understand the fundamental accounting concepts through simplified technical discussions and practical applications of the accounting standards. All of this to help you go from zero to hero. IAS 21 covers the effects of exchange rates and translations. The main objectives of this standard is to prescribe how to account for transactions in foreign currencies and how to translate financial statements into a presentation currency. This is the general summary of IAS 21, with the main goal of identifying what specific FX rates to use in the evaluation of financial statement items as an effect of in-scope activities. The standard also guides us on how to account for the effects of foreign currency fluctuations or changes. However, in order to arrive to those conclusions, the first step in the application is actually to determine what is the functional currency of the entity. An entity's functional currency is the currency of the primary economic environment in which it operates. We should determine the functional currency of each entity within a group because a group does not have a single functional currency. This is assessed separately for each individual entity. One last reminder is that the accounting records are kept in the functional currency. According to the standard, the functional currency is the currency that mainly influences the price at which goods and services are sold, the currency of the country whose competitive forces and regulations mainly influence the entity's pricing structure. It is also the currency that influences the costs of the entity. The first three are the primary factors identified by IAS 21. The next two factors serve as supporting evidence of any conclusions. It can be the currency in which funds are generated, or it is the currency in which receipts from operating activities are retained. Once the functional currency has been determined, then we are good to go. Any transaction denominated in a currency that is not the functional currency is a foreign currency transaction, which is the next step in our diagram. When you have a foreign currency transaction, you should value the elements of the financial statements affected during two periods. The first, during initial recognition, which is the date when the transaction actually happened, and subsequent measurement, which is normally during the end of the accounting period. During initial recognition of a transaction, we simply record all debits and credits using the spot rate as at the transaction date. For example, if in the middle of the year we incurred an unpaid supplier expense denominated in a foreign currency, we just record both expense and liability using the spot rate during the date of the transaction. There is no gain or loss recorded at initial recognition. As at year end, the treatment of the items will depend if the asset or liability recorded as a result of the foreign currency transaction is a monetary or a non-monetary item. Any income or expense items recorded during the initial recognition are generally unchanged and remain to be recorded at spot rate in the income statement. Let us now define what are monetary and non-monetary items. Monetary items are defined as units of currency held and assets and liabilities to be received or paid in a fixed or determinable number of units of currency. Most common examples of monetary items include trade receivables, trade payables, or bank loans. The settlement of these items are determined in a fixed or determinable amount of currency, or more practically speaking, in a specific or determinable amount of cash. A non-monetary item, on the other hand, is the absence of a right to receive or the absence of an obligation to deliver a fixed or determinable number of units of currency. Examples of non-monetary items include goodwill, property, plant, and equipment, intangible assets, inventories, and provisions that are to be settled by the delivery of a non-monetary asset. In general, these are assets and liabilities that exist in the balance sheet but are not normally expected to be collected or settled using monetary items such as cash. Going back to the diagram, if the asset or liability is a monetary item, or if it's a receivable, for example, We translate it using the closing rate as at year end, and any gain or loss from FX fluctuations flow to the P&L. However, if an asset or liability is a non-monetary item, we need to determine its nature. If the item is carried in the accounting records at historical cost, we translate it using the spot rate used when the item was originally acquired. For items at revalued amount, such as most investment properties at fair value, the item is translated using the spot rate as at revaluation date, and any gain or loss from FX fluctuations will follow where the revaluation gains of this asset are recorded. So it can be through P&L or equity or OCI, depending on the type of asset or liability. By now, we have already covered approximately half of the coverage of IAS 21. With that, we will move on to the concept of foreign operations and translations to presentation currency, which are a little bit interrelated. We can best understand this by going into the concept of foreign operations first. A foreign operation is a subsidiary, associate, joint venture, or branch whose activities are based or conducted in a country or currency other than those of the reporting entity. When a foreign operation has a different economic environment resulting to a different functional currency as that of its parent, we need to find a way to translate its financial statements to the same currency of the parent to be able to consolidate the group. This is where the concept of the presentation currency comes in. The presentation currency is simply the currency that is used to present the financial statements. Foreign operations will normally have a presentation currency that is different from its functional currency, because foreign operations should follow the presentation currency of the parent in order to be consolidated within the bigger group. In other special circumstances, even though a company is not a foreign operation, they can have a different presentation currency even though it's not a foreign operation. This will be on a case-by-case basis. However, for most companies, the presentation currency is the same as the functional currency. So what happens when you need to translate the accounting books, which are maintained in the functional currency, to the presentation currency? IAS 21 is quite straightforward in this. Assets and liabilities shall be translated using the closing rate. Income and expenses shall be translated using the spot rate, or as a practical expedient, using the average rate during the period. Any resulting differences required to balance the balance sheet is recorded in other comprehensive income. So this about summarizes the main provisions of IAS 21. Let us know if you want to discuss more examples in the comment section below. I do hope that you learned something from this discussion. If you want to watch more accounting related videos, don't forget to subscribe and click the notification bell. See you!